Picture this. While stock markets wobble and crypto crashes make headlines, there's one asset quietly crushing every prediction. Gold just shattered its all-time highs, and the smart money is paying very close attention. But here's what nobody's talking about. This isn't just another precious metals rally. What's happening right now with gold is sending a massive signal about where silver prices are headed in 2026, and if you're not positioned correctly, you're about to miss one of the biggest wealth transfers of the decade. Gold has become the ultimate safe haven as central banks worldwide go on an unprecedented buying spree, geopolitical tensions escalate, and the US dollar faces its most serious challenges in generations. We're witnessing something extraordinary. Gold is leading markets in a way we haven't seen since the 2008 financial crisis. But this time, the catalysts are even more powerful and longer-lasting. Here's the critical piece most investors are missing. Silver has historically followed gold's explosive moves with even greater percentage gains. The gold-to-silver ratio right now is creating what seasoned traders call a generational opportunity. In this video, I'm breaking down exactly why gold is dominating, what the technical and fundamental indicators are screaming about silver's trajectory, and the specific price targets you need to know for 2026. Whether you're a precious metals veteran or just starting to protect your wealth, what I'm about to share could reshape your entire investment strategy. If you're ready to understand where this market is really going, smash that like button right now, and let's dive deep into the 2026 global outlook. Let's start with the elephant in the room that mainstream financial media keeps dancing around. Gold's performance over the past 18 months has been nothing short of spectacular, and it's happening for reasons that go far deeper than simple supply and demand dynamics. We're talking about a fundamental shift in how the world views money, sovereignty, and economic security. Gold recently pushed past $2,100 per ounce and shows absolutely no signs of slowing down. But to understand where silver fits into this picture and why 2026 could be silver's breakout year, we need to understand the forces driving gold's unprecedented rally. The first and perhaps most significant driver is central bank buying, and this isn't your typical accumulation pattern. Central banks globally purchased over 1,000 metric tons of gold in 2023, and preliminary data suggests 2024 and early 2025 numbers are tracking even higher. This represents the highest level of official sector demand in over 50 years. But why are central banks suddenly hoarding gold like there's no tomorrow? The answer reveals everything about where we're headed economically. Central banks in China, Russia, India, Turkey, and dozens of other nations are systematically reducing their dependence on US dollar reserves. This isn't conspiracy theory territory. These are official reported purchases through the World Gold Council. These institutions manage trillions in assets and have access to economic intelligence that would make your head spin. When they move decisively toward gold, they're telling us something profound about the future stability of fiat currencies and the international monetary system. The geopolitical landscape has transformed dramatically, and gold has always thrived during periods of heightened uncertainty. We're living through multiple overlapping crises right now: the ongoing tensions between major powers, the fracturing of globalization, supply chain vulnerabilities exposed during recent global disruptions, and the weaponization of currency systems have all contributed to what analysts call a multipolar world order. In this environment, gold becomes the ultimate neutral asset. It owes allegiance to no government, cannot be printed into existence, and has maintained value across 5,000 years of human civilization. When trust in institutions wavers, gold becomes the trust anchor. Now let's talk about inflation and monetary policy, because this is where things get really interesting for both gold and silver. Despite central banks claiming victory over inflation multiple times, the underlying inflationary pressures remain stubbornly persistent. The unprecedented monetary expansion during recent economic crises injected trillions into the global financial system, and that money doesn't just disappear. It works its way through the economy, creating asset price inflation, persistent goods and services inflation, and fundamentally altering the purchasing power of every major currency. Real interest rates, that's nominal rates minus inflation, remain historically low or even negative in many jurisdictions. When you can't earn a real return on bonds or savings accounts, gold becomes infinitely more attractive because it preserves purchasing power without counterparty risk. The technical picture for gold also reveals something crucial that sets the stage for silver's potential explosion. Gold has broken out of a multi-year consolidation pattern and established what technical analysts call a confirmed uptrend with higher highs and higher lows. Every pullback gets bought aggressively, indicating strong underlying demand and conviction from large institutional players. The moving averages have aligned bullishly, momentum indicators show sustained strength, and most importantly, gold is outperforming virtually every other major asset class. When gold leads markets this decisively, it's not a short-term trade, it's a macro regime change. So where does silver fit into this narrative? And why should precious metals investors be getting extremely excited about 2026? Silver occupies a unique position as both a precious metal and an industrial commodity, and this dual nature is about to become silver's superpower. Let's examine the industrial demand side first, because this is where silver diverges dramatically from gold and why its upside potential could be substantially larger. Silver is absolutely critical to the green energy transition, and this isn't some distant future scenario. It's happening right now at an accelerating pace. Solar panels require significant amounts of silver for their photovoltaic cells, and as the world races toward renewable energy targets, solar installations are projected to increase exponentially through 2030. Every major economy has committed to aggressive decarbonization goals, and solar energy is the fastest-growing segment of renewable power generation. Each solar panel uses approximately 20 grams of silver, and when you're talking about hundreds of millions of panels being manufactured annually, that translates to enormous industrial demand that simply cannot be satisfied by current mining production. Electric vehicles represent another massive demand driver that's only beginning to impact silver markets. EVs use significantly more silver than traditional internal combustion engine vehicles due to their electrical systems, battery management, and power electronics. As EV adoption accelerates globally, and it is accelerating despite some recent headline concerns, silver demand from the automotive sector is projected to double or triple by 2030. We're also seeing silver's critical role in 5G infrastructure, advanced electronics, medical applications, and water purification technologies. This industrial demand creates a floor under silver prices that gold simply doesn't have. Here's where the supply situation becomes fascinating and bullish for silver investors. Unlike gold, where annual mine production roughly matches demand, silver faces a structural supply deficit. The Silver Institute and other research organizations have documented that demand has exceeded newly mined supply for several consecutive years, with the deficit being filled by above-ground inventories and recycling. But here's the problem. Those inventories aren't infinite, and recycling cannot scale fast enough to meet surging industrial demand. Silver mining is largely a byproduct of other mining operations, particularly copper, lead, and zinc. This means silver supply is relatively inelastic and cannot quickly respond to price increases the way a primary mining operation might. The gold-to-silver ratio is perhaps the most compelling technical indicator for silver's potential breakout in 2026. Throughout history, this ratio has fluctuated between roughly 15 to 1 in ancient times to highs of 100 to 1 during periods of extreme stress. The long-term average sits somewhere around 60 to 70 ounces of silver to 1 ounce of gold. Currently, the ratio is trading above this historical average, suggesting silver is undervalued relative to gold. When gold enters a strong bull market and the ratio begins compressing, meaning silver starts outperforming gold, the moves can be explosive. We saw this during the 2010 to 2011 precious metals rally when silver nearly reached $50 per ounce, vastly outperforming gold on a percentage basis. Historical precedent gives us a roadmap for what could unfold. During the last major precious metals bull market from 2008 to 2011, gold roughly tripled while silver increased by approximately 5 times. The leverage that silver provides to gold's moves is well documented across multiple cycles, When institutional money and retail enthusiasm converge in the precious metals space, silver benefits disproportionately because of its lower absolute price, smaller market size, and the psychological appeal of being able to accumulate larger quantities. $1,000 buys you less than half an ounce of gold, but could purchase 30 or 40 ounces of silver at current prices. This accessibility factor should not be underestimated when retail investment flows begin accelerating. Let's discuss the specific catalysts that could drive silver prices substantially higher through 2026. First, if gold continues its ascent toward $2,500 or $3,000 per ounce, which many respected analysts now consider likely given the macro backdrop, silver will inevitably be pulled higher. The correlation between gold and silver is strong, though silver tends to lag initially before catching up with explosive moves. Second, any significant supply disruptions in major silver-producing countries could shock prices higher rapidly. Silver mining is concentrated in relatively few countries, with Mexico, Peru, and China being dominant producers. Political instability, regulatory changes, or operational challenges in these regions could constrict supply precisely when demand is accelerating. Third, the investment demand side of silver remains dramatically undersupplied relative to its potential. Silver ETFs, physical bullion sales, and institutional allocation to silver are all minuscule compared to gold. Global silver ETF holdings represent a tiny fraction of annual investment flows, suggesting enormous room for growth if precious metals sentiment continues improving. When we witnessed the brief silver squeeze phenomenon in early 2021, prices jumped from roughly $25 to nearly $30 in days on relatively modest buying pressure. Imagine what sustained institutional accumulation could accomplish. Fourth, currency debasement concerns are only intensifying. Government debt levels across developed economies are at peacetime records, and the political will to implement meaningful fiscal restraint appears non-existent. As debt monetization continues and currencies lose purchasing power, hard assets like silver become increasingly attractive stores of value. The monetary policy trajectory also favors precious metals broadly and silver specifically. Central banks are trapped in a policy corner where raising rates sufficiently to truly combat inflation would trigger recessions and debt crises, while keeping rates too low perpetuates inflationary pressures and currency debasement. This Goldilocks nightmare for policymakers is a dream scenario for precious metals. Even if rates rise modestly, they're unlikely to exceed inflation rates meaningfully, keeping real rates suppressed and precious metals attractive. If rates must be cut to support economic growth or financial stability, that would be rocket fuel for gold and silver prices. China's relationship with precious metals deserves special attention because it could be the wild card that accelerates silver's ascent. Chinese demand for both gold and silver has been substantial and growing, driven by cultural affinity for precious metals, wealth preservation concerns given domestic economic challenges, and strategic considerations about de-dollarization. If Chinese retail and institutional buyers increase their precious metals allocation even modestly, the impact on global prices could be substantial given the size of Chinese capital markets and the relatively small size of physical precious metals markets. Now let's get specific about price targets and what investors should realistically expect for silver in 2026. Conservative analysis suggests silver testing $40 to $50 per ounce is entirely feasible if gold reaches $2,500 to $2,800. This represents roughly doubling from current price levels around $25 to $30. More optimistic scenarios that account for potential supply shocks, accelerated green energy adoption, or a genuine precious metals mania could see silver challenging or exceeding its inflation-adjusted all-time highs, which would place prices somewhere in the $60 to $80 range or higher when adjusted for current dollar purchasing power. The key for investors is understanding that precious metals moves rarely follow straight lines. Silver especially is known for explosive rallies punctuated by sharp corrections that shake out weak hands. The volatility can be intense, with 10 or 15% moves in either direction happening within days or even hours during periods of heightened activity. This volatility is actually what creates the opportunity for substantial gains, but it requires conviction, proper position sizing, and the emotional fortitude to withstand the inevitable turbulence. From a portfolio construction perspective, the traditional recommendation of 5 to 10% precious metals allocation is being reconsidered by many advisors given current macro conditions. Some prominent investors and fund managers have suggested 15 to 20% allocations could be appropriate for those with strong conviction about currency debasement and economic instability. Within that precious metals allocation, the split between gold and silver should reflect your risk tolerance and return objectives. Gold provides more stability and wealth preservation, while silver offers greater upside potential with increased volatility. Physical ownership versus paper exposure is another critical consideration. Physical bullion provides direct ownership without counterparty risk, but involves storage considerations and slightly higher transaction costs. ETFs and mining stocks offer liquidity and ease of trading, but introduce counterparty risk and don't provide the same tangible security as physical metal. A balanced approach using physical for core holdings and paper products for tactical positioning often makes sense for most investors. Mining stocks can provide leverage to metal price moves, but introduce company-specific risks, operational challenges, and jurisdictional considerations that pure metal exposure avoids. The technical setup for silver entering 2026 looks increasingly constructive. Silver has established support levels that have held through multiple tests, creating a base from which breakouts typically launch. The moving average structure is improving, with shorter-term averages crossing above longer-term ones, indicating shifting momentum. Volume patterns suggest accumulation by informed buyers during pullbacks. Relative strength against other commodities and assets is building, which historically precedes significant moves. The options market is also showing increasing interest, with open interest expanding and implied volatility suggesting larger price moves are anticipated. Sentiment indicators are worth monitoring because precious metals markets are heavily influenced by psychology and positioning. Currently, sentiment appears cautiously optimistic but not euphoric, which is actually ideal for sustained rallies. When everyone becomes wildly bullish and mainstream media celebrates precious metals, that's typically closer to cycle tops. We're nowhere near that kind of enthusiasm yet, suggesting substantial upside remains. The managed money positioning in futures markets shows room for additional long positions to be established before reaching stretched levels. Global economic fragmentation and the push toward alternative monetary systems could accelerate precious metals' role in international commerce and reserves. We're seeing discussions about commodity-backed currencies, precious metals-settled trade agreements, and the potential integration of gold and silver into new monetary arrangements that bypass traditional dollar-centric systems. These developments remain largely speculative and long-term in nature, but they represent tail risk scenarios where precious metals could revalue dramatically higher relative to fiat currencies. The debt ceiling debates, fiscal sustainability concerns, and the inevitable recognition that current spending trajectories are unsustainable will continue driving safe haven demand for hard assets. Political polarization in major economies reduces the likelihood of consensus solutions to fiscal challenges, making the path of least resistance continued deficit spending and monetary accommodation. This is the environment where precious metals thrive across multiple cycles. For silver specifically, the energy storage revolution could provide yet another demand catalyst. As grid-scale battery storage becomes essential for renewable energy integration, silver's superior electrical conductivity properties make it valuable in various battery and energy storage technologies. Research into silver-zinc batteries and other advanced storage solutions could create entirely new demand vectors that current market analyses haven't fully incorporated. The bottom line is this: gold is leading markets because it's doing exactly what it was designed to do: preserve wealth during periods of monetary instability, geopolitical stress, and economic uncertainty. The forces driving gold higher are not temporary or reversible in the near term. They represent fundamental shifts in the global economic and monetary order that will likely persist and intensify through 2026 and beyond. Silver, as gold's more volatile and industrially essential cousin, stands poised to deliver outsized returns as these trends unfold. The combination of investment demand following gold, industrial demand from unstoppable technological and energy transitions, constrained supply, and favorable technical positioning creates a compelling bullish case. Investors who position themselves appropriately in precious metals, particularly silver, before mainstream recognition of these dynamics could be rewarded substantially as 2026 unfolds. The key is acting before the crowd, maintaining conviction through inevitable volatility, and understanding that this isn't a trade but rather a strategic allocation to hard assets in a world of increasingly questionable paper promises. Gold is sending the signal, silver is primed to respond, and 2026 could be the year when precious metals remind the world why they've maintained value across millennia of human economic history.